Welcome to TheoTrade. This is Don Kaufman here doing the weekend update on August 12th, 2017. Well, this past week we saw quite a bit of volatility, and as such, we have an itinerary of items that we're going to be covering in this weekend's update. First, a market update of some of the previous action and really some of the opportunities I think that exist. Number two over here, we're going to be talking about specific levels in the S&P 500 and be forward looking to the expected moves. Number three on our list, volatility in selling options. Anytime we see a degree of volatility in the marketplace, everybody immediately jumps in and wants to sell options. Well, let's talk about where that might be the most risk and where that might be the most opportunistic. And last but definitely not least, an Apple trade idea. So let's get right to it with a, again, kind of a brief overview of some of the action in the marketplace. Quite frankly, the trading week started out with one of the lowest volume trading sessions really on record. And that was on Monday. We only did like 500,000 contracts, which is unheard of how light it was. I mean, even like the day before like Christmas, you know, that's the kind of volume you see in like a half a trading session. Nevertheless, okay, markets, they stagnate. They don't move at all, ultimately until some geopolitical risk comes out. So you have to kind of ask yourself as a trader or as an investor, okay, at times like this, was it the geopolitical risk, or is it a marketplace that's been stagnating and been rallying now for ultimately for years? Okay, was the market just looking for an excuse ultimately to sell off? And the reason I bring that right to the forefront is because at this point in time, as a investor and or as a trader, I know that we're all going to start, tuning into the news. You're going to start reading all about the geopolitics, but be frank about that. Is that really going to help you? Okay. You're going to get nerves out there and so forth. Listen, you're still not going to understand how order flow is going to play out. And in this, I'm going to be talking about some specific levels here, but before I go into any of the levels, I want to show you where really some damage was done in the marketplace ultimately on Thursday. Okay, obviously we had a little bit of a rally back in the Nasdaq on Friday, but let's get into some of the details. But put aside what you might think, any preconceived notions about the geopolitics, because again, even if you had insight to it, it's still not going to deliver to you how order flow is going to play out in this marketplace. And I think that's the key point. So with that, I want to start with a kind of percentage year to date. And I want to look at a number of products. I'm going to start with the spiders. Okay, it's the S&P. So the S&P year to date is roughly up about 8%. Great, done. Moving to the NASDAQ year to date is still up. Okay, we took a little bit of a hit, but it's still up almost 19% year to date. And this is just, again, all I did was just pull up a year to date, flipped the chart onto percentage view. Last but definitely not least, the Russell. Okay, so when I start talking about what's taking a hit, what is apparent and what has been transparent for the last, almost 3 weeks of trade, the Russell has already been in the midst of a sell-off. And that's why I initially questioned, I'm like, well, was it the geopolitics or was it the fact that the Russell, okay, has already been in a fairly severe downtrend? Again, the Russell is up only 0.7% year to date. So that is, in terms of your indices, whether it's the S&Ps, the NASDAQ, or the Russell is clearly the weakest of the products over there. Right off the bat, therein lies a trade. If you hate the NASDAQ right now and you're like, oh, I need to short the NASDAQ. Yeah, but you might want to be short NASDAQ, possibly long Russell. This is the underperforming product. With that, let's get into some real specifics over here, because I've also been pointing out, ultimately the XLF had a turning point. What in one of the videos we actually called kind of a key reversal. It was even poking fun at the fact that it was like, it's a doji hammer over here. But the XLF is also in a pretty serious downdraft at this point. On a percentage basis, let's put exact numbers to it. So ultimately, this is on a year to date. The XLF, which of course is the financials, was up about 8.5%. okay, it was almost up about 9% at the peak. Now, okay, takes a hit. So from absolute high over here to where we're currently trading, it came in just shy of about 4%. Not half bad though for a few trading days. The point though I want to make with this is the XLF looks vastly different than does the S&P chart. It looks vastly different than the Nasdaq chart, and the XLF, the financials specifically, well, they're starting to look a little bit more like the Russell. And the reason I mention that in this market update over here is because the XLF, it's driving the S&Ps. Like, this is what's driving the S&P futures. Okay, and you probably ask, hey, the S&P futures on Friday, okay, after some fairly extreme volatility, the S&P futures finished unchanged for the most part on Friday, up 3 points, pretty close to unchanged. Why didn't they rally? Because the Nasdaq, I mean, it literally got back half of what it lost. And the answer to the S&Ps lies in the fact that the financials, number one, were very weak on a relative basis. Number two, you've also got weakness inside of energy. Now, if you haven't looked at energy on a year-to-date basis, again, I'm always looking for opportunity. It doesn't matter in a market update. Hey, newsflash, the market sold off a little bit this past week, okay? But here's an opportunity. The XLE energy sector is down about 16% on a year-to-date basis. I've been out here and I've actually been selling puts in the XLE, and it's right back down to that 64 level, where once again I start to think it's a little bit advantageous. But let's move forward, okay? So again, newsflash, market sold off a little bit. But let's get to number two over here, levels and expected moves. First and foremost, I'm going to bring up the SPX, and I'm going to kind of zoom in the SPX, okay, more recently to some of the expected moves that we have seen. And again, what you can expect in just the next couple of trading sessions over here. Now, for those of you kind of uninitiated, unaware, what the expected moves happen to be that are drawn on this chart here, and I'll kind of zoom in a little bit tighter for you. This is the expectations of movement based on option premium, okay? Ultimately, what you're seeing here in terms of expected move, last week we expected $22 higher or lower. It's about 22 bucks. What did we actually get? Well, we started the week out right in this neighborhood, okay? We cracked all the way down to the 41 level. So for the most part, again, let's be very, very specific. You can actually look all of this data up. How do you actually look this data up? You can come in to think back. Today's the 12th. We can actually go back, for instance, to like the 5th, and you look back exactly at, a full week in data over there. Again, over to the Analyze tab, into Think Back if you are on, again, if you were on thinkorswim. And you can see last week we closed right around 24.76. Right now we're trading 24.41. So you're looking again, well, we were expecting, a $22, $23 move. What did we ultimately get? Do some quick and dirty math over here, about a 35-point move, okay? So it's one of the few weeks recently, in recent history, it's one of the few weeks that we've cracked outside of the expected move, and specifically cracked outside of it to the downside. The last time this happened, okay, was really the week where we saw massive selling on March 21st to close this far outside of an expected move. But most definitively, we did close outside of the expected move. Now, continuing on with expected moves, specifically in the SPX, this coming week, let me close up this left sidebar. This coming week, plain and simple, we're expecting now about a $41.75 expected move. Let's just round it to 42 bucks. So if you want definitive levels over here, okay, the SPX closes right around 24.41. To the upside, if we were to rally to the upside of the expected move, you're looking at about 24.83. To the downside, are you going to love this? Pretty much 2,400 on the button, okay? So a $42 expected move for the week. All you got to do is glance back and you're going to see that's one of the most serious expected moves that we've seen in quite some time, right? We can elaborate a bit more. There was an expected move back, prior to the French election that was also really formidable. Okay, that was actually in the neighborhood. Again, you're looking at an expected move from, the 48 level almost, okay, up to the 2400 level. But you are looking at one of the largest expected moves that we've seen, okay, in recent history, following, ironically, one of the smallest expected moves because we've had nothing in terms of price action recently. Next, we'll come over to the Qs, okay? Let's go over here to the Qs. What are we looking at in the Qs for expected move? Again, we breached the expected move in the Qs last week, came back inside of it by the end of the week. But the Qs are also expecting some fairly intense volatility. We're actually all the way up to an 18.5% in volatility, almost a $3 expected move. Now, the Nasdaq has seen substantial expected moves. Okay, more recently, obviously, coming into like May, we saw some wild moves inside of the Nasdaq. However, again, the Nasdaq looking at almost a $3 expected move. Okay, back to our itinerary over here. That's a little bit about being forward-looking, looking at some of those expected moves. Let's get to levels. Why levels? Okay, levels are of critical importance, absolutely of critical importance moving forward. Okay. I know that everybody wants to try to handicap like, all right, we're going to go up, we're going to go down, we're going to do this. Again, please, with the geopolitical risk out there, okay, you can say it's geopolitical risk or it's a marketplace that's been drastically overbought. Again, we just looked at the Nasdaq. The thing is up almost 19% year to date. And that's after selling off a little bit. Now, put aside preconceived notions about individual stocks. You can look at every single stock on the screen, but the truth be told, if the markets are going to sell off, okay, all right, for one reason or another, and again, geopolitics aside, it doesn't matter whether you're trading, a Google and an Amazon and, an Apple. In fact, we'll talk about an Apple trade here in just a moment, or a Microsoft. It simply does not matter, okay? Now, in terms of specific levels, the ones that you want to count on over here, 2438. I talked about this just the other day, okay, in the market update. 2438. This is a key inflection point. Don't look at it as support and resistance. It's where risk ultimately lies, okay? It's an inflection point. From 2438, if we push off, get a couple points higher, we could explode substantially higher. The first stop along the way, okay, from 2438, the first stop along the way is somewhere just north, okay, of 2450 in the S&Ps. And again, this is to the S&P futures. This is the S&P futures that I'm actually quoting levels on. So look at this as a little bit of a gateway. And again, that exact number is 2438. Put a price level on your chart, 2438. If we actually start to sell off over here, we drop pretty good. You're actually looking at 2411. Now again, these levels, this is not something we're just pulling out of thin air over here. These levels, okay, have been risk levels that have been in place now for months. Specifically, if you would like to see it, you can kind of do some homework on your own over here. But what you want to do is back up. It's an intraday, look at 90-day, 2-hour chart. And you'll actually see us pinging back and forth, okay? And again, you can't even make this stuff up. Literally from 2411 right into the 2438 handle, back and forth. The issue that you've got right now is if we start to push off that 2438 to the downside, it is a straight and quick drop to 2411. So why even mention these levels? Like, how are they going to help you? Listen, you're a retail trader. You're getting nervous about the market selling off, okay? If you're nervous about the market selling off, well, I'll tell you what, 2411, pretty much hang your hat on the fact that if we do sell off, we're going to stop at that level. It'll actually give you an opportunity to breathe, to think, and to possibly exit positions if you don't like it. Period. That's it. That's what you use the level for. For those of you that trade on an intraday basis, if you're bearish out there, we swing down to 2411. Yeah, all right. We had some downside over here. Party's over. 2411, we should stop dead cold, meander for a while. And that's exactly the action that we saw. Okay. Look at the marketplace the other day. We stopped cold, 2438, meandered around, popped our head back above it. But again, it's just a risk barrier. It's where a huge amount of risk kind of exists. So those are your primary levels, 2438 to the downs and to the downside, ultimately 2411. But below below 2411, things get crazy. You crack through 2400, it's crazy. There are no levels at those points. Okay, so that's a little bit about levels expected moves. Next, volatility and selling options. A lot of people are going to get this wrong. They're going to look to sell options premium. They're going to look to sell options premium. Now, this is going to get a little bit deep over here. If you're going to sell options premium, the volatility did rise up a bit. It did rise up in the SPX just a bit. But for those of you that understand volatility and understand volatility in premium, the IV percentile, okay, the IV rank is at 45% in the SPX. What that basically means, okay, is if you look at implied volatility over a 52-week period of time, the high and the low, okay, the high point was up here at 23%. So for the most part, the highest point that we've seen in volatility over the last year has been 23%. The lowest implied volatility, you can see right there, has been just about 9.5%. Okay, so what this IV rank does, it says 45%. What does that mean? It means we're in the middle of the road. So if IV goes high and IV goes low and IV goes high and IV goes low, right now we're right smack in the middle of the road at about the 50th percentile. I know it's the 45th percentile, but one and the same over there. Okay, got it, get it, good. The reason is, don't you dare sell anything inside of the SPX because you're missing the bigger picture. The bigger picture is the professionals are no longer going in. They're no longer going in, okay, and buying premium in the SPX. They're doing it in the VIX. The VIX options are being used to mitigate risk, and the VIX IV percentile is all the way up to the 87th percentile. The 87th percentile, which means that just the other day, the volatility in the VIX, okay, in the VIX actually hit the 100th percentile. What that effectively means, it was the highest volatility that's been recorded. The highest volatility been recorded in the VIX itself anytime in the last 52 weeks. Okay, so if there's going to be a place that you're going to sell premium, it needs to be in the VIX options themselves. The VIX options, that's something, again, we'll talk about throughout the course of this week in TheoTrade, but nobody's looking at this stuff. And I'm telling you, it's like incredibly frustrating. Look, it's one of the highest volatilities that we've seen over the last 3 years. And this is your opportunity. Could the volatility go higher? Yeah, but over the last 3 years, the volatility really hasn't been much higher in the VIX options than it is right now. So you look at this and you want opportunity. It's not to sell premium, okay, in JP Morgan. It's not to sell premium in Caterpillar or the SPX. You want to sell premium where it's the juiciest, and it's the juiciest right now inside of the volatility contracts themselves, which happen to be specifically related to the VIX. Now, let's get to an Apple trade idea. All right, so let's get to it, the Apple trade idea. I've gone ahead and gone to the trade tab, typed in Apple, opened up the September 8th expiration with 27 days remaining. You can see I've highlighted here the 162.50 calls. Now, what we're going to be building is called a ratio butterfly. Again, it's a ratio butterfly, better known as a 1-3-2 ratio butterfly. Okay, how do I build this? Well, I'm going to go ahead and right-click. Again, right-click on the 162.50s, go up to buy. Okay, over here to unbalanced butterfly. Immediately, what will populate here in the order entry bar is, in fact, a 1-3-2 ratioed butterfly. Now, this one, you're thinking, oh, okay, it's going to get a little bit deep over here. What does this trade really look like? What is it really composed of? For that, I'm going to take you onto the thinkorswim Analyze tab. Now, I've already gone ahead and dropped the trade into the Analyze tab, and I want to take you through a couple of the nuances of, number one, why is this trade so viable? And number two, okay, how can you actually build trades like this ultimately yourself? So some of the attributes of the trade. One of the things that you'll notice, okay, and some of you may have a bit of experience here, and you're looking at the risk graph and you're thinking to yourself, well, that looks kind of like a broken wing butterfly. It's similar, okay, but the ratio itself of buy 1, sell 3, okay, buy 2, that 1-3-2 takes full advantage of what we term skew. Okay, so it takes advantage of the skew. The other thing that's a little bit peculiar about the trade is the trade is actually being done for what appears to be a credit, and it is a credit, but there's a little minus sign in front of it. The little minus sign, okay, that just denotes that there's risk in the trade. But I want to show you how much risk is there really in the trade. Like, let's look at some of the attributes of the trade. Like, why are we going to do this? Okay, well, first of all, you can make as much as, if you hit it right on the top over here, just over $300, but we're going to call it about 300 bucks. You can make as much as 300 if you hit right smack on, the butterfly, and that butterfly really falls at 162.50. Okay, so where is, Apple trading right now? Is this going to be bullish? Is this going to be bearish? We're going to show all the attributes. Again, what's the most I can lose? Well, you can lose as much as $174. But even if the market on Apple, okay, even if the market on Apple tanks right now, you still get to keep this $76 credit. So if the market tanks on Apple, you keep 76 bucks. Okay? If the market comes right to 162.5, you make what? 300. And if we rally huge, in fact, above 164. Now, just a minute over there, 164. Apple has never been there before. Apple right now is trading at 157. Okay? It's never been, would have to break into all-time new highs. Is it possible? Absolutely. Okay, but again, this trade is made possible by what is termed skew right now. So if you start to think about this, again, kind of in context, Apple's got to break to all-time highs. You can make 300 bucks, even if the stock does start to rally, because the stock's right here, right now. It's got to rally up, okay? If it sells off, what do you got? You got 76 bucks. If it rallies huge, you can make as much as 300, okay? And if it rallies all the way, okay, to 165, you could lose $174. But you got to love this because you have a 73% probability of not losing anything. When was the last time that you ever had an opportunity where you're risking 174 to make 300, okay? If the market tanks, you still make 76 bucks. But again, you're risking 174 to make 300 with a 73% chance of not losing anything. Okay, I know there's a lot of little nuances to this trade, and that's exactly why we're going to host a class on the trade. It's the next class I'm doing here. That class is coming up next Saturday. Okay, next Saturday. Here are all the details, okay, and the site, TheoTrade.com/ratio. TheoTrade.com/ratio. It's the beginner's guide to ratio butterflies class. I'll be the instructor. Again, it's August 19th, 10 a.m. to 1 p.m. It's a 3-hour class. The class, it's $97. That's it. The class is $97. We're also including a number of bonuses with the class. We're going to give you the options 101, options 201, that's vertical and calendar essentials, okay, and options 301, volatility essentials. As I said, this trade is actually based on volatility skew. Okay, what is the class really going to be composed of? Well, I'm going to talk about specifically, clearly, these ratio 132 butterflies. You can actually risk 1 to be able to make 2 with a 70% chance of not losing anything. It's exactly what I was just lining where, and it's a real trade, obviously, here in Apple. We're going to show you how volatility skew can benefit you and how volatility skew works better using a 132 ratio than any broken wing butterfly, why ratio butterfly spreads, they really do transcend market conditions, okay? It'll work, again, up, down, sideways markets. I have designed the trade to be bearish in this particular instance, but as you saw, okay, was this trade really bearish? This is where the market is right now. If we sell off, we make money. If we rally a bit, we make money. If we rally huge, is the only way we can actually lose on here. So again, it's a wonderful trade to really add to your arsenal. And then, of course, I'm actually involved right now in just building the most step-by-step guide on how to really enter and exit these ratios. And I'm all about criteria. And that's what that step-by-step guide is. And I've had specific criteria for ratio butterflies for years. And in this kind of instance, in building this ratio course, I have redone the criteria with infinite amounts of depth over here. If you know what a call or a put is, you'll be able to place these trades. And of course, the entire class and all the bonuses are available, unlimited. Okay, my PowerPoints will be available in a PDF slide. Okay, indefinitely. You have access to all of it. Again, all of it over there. We'll also give you a discount rate at TD Ameritrade. Again, the entire class, it's $97. Just visit TheoTrade.com/ratio. Thanks everybody for joining us here for the weekend update. Have a wonderful afternoon. Bye-bye.